Okay, in between accounts receivable and accounts payable, accounts receivable is the good one. It means we've done the work or we've sold them the goods. We've earned the revenue. So we've sent out an invoice. We've debited accounts receivable. But sadly, not all our customers are going to pay us. And there are two different ways to account for that bad debt expense. The first one is called the direct method, and it's the one that the IRS says we have to use when we prepare our tax returns. So let's pretend like we did some work for Johnson Company. So we send them a bill for $100, accounts receivable is an asset, assets increase with debits, and we credit sales for $100. So remember, if expenses are debits, the opposite of expenses is sales or revenue, and those must increase with credits. And remember, this keeps track of our sales, whether we get paid today, tomorrow, or never. And so we send out the bill, and February comes, they don't pay us. March comes, they don't pay us. April comes, we start sending them letters, and we start calling them every day. Finally, we call one last time, and the phone's disconnected. So we know we've got to write this thing off. That account receivable is no longer good. So in the direct method, it's pretty simple. Let's say it's July 1st, and we decide to write them off. That account receivable is on our books with a debit balance of $100. So to zero it out, we're going to credit it for $100. And then we're going to debit bad debt expense for $100. And so that's pretty simple and straightforward, and GAAP says we're not allowed to use that method. GAAP says we have to use what's called the allowance method. In our heart of hearts, when we make sales, we know that not every customer is going to pay us. And so that bad debt expense associated with those sales should be booked in the same period as the sales. Let's see how that works. Same transaction. $100 worth of accounts receivable, $100 worth of sales for the Johnson Company. Well, since this is, say, January 1st and say it's a new fiscal year, we also have to estimate our total bad debt expense. So let's pretend like we estimate our total bad debt expense to be $2,228. But we can't credit specific accounts receivable like we did up here because we don't know which specific customers aren't going to pay us. If we knew that, we wouldn't have sold them stuff in the first place. So we have to create a placeholder account. That placeholder account is called the allowance for doubtful accounts. And we're going to use that every time we want to write off a specific account receivable. So same facts, they don't pay us in February, they don't pay us in March, we start sending letters, we start calling, we finally call, and the phone line's disconnected. So we have to write off that account receivable. So just like we did before, we credit accounts receivable Johnson for $100, but we don't book bad debt expense. We debit allowance for doubtful accounts. We use up part of that $2,228. So what we've done is we put that bad debt expense in January when the sale was made, and then we've used this placeholder account to write off that account receivable when we discovered that that asset is no good. Well, how did we come up with that $2,228? So there's two methods to estimate accounts receivable that are going to go bad. One looks at the income statement, so as a percentage of sales, maybe 1/2 or 1/4 of 1% of our sales we estimate to be bad debt expense. The other looks at our balance sheet, and so we age our accounts receivable. So if somebody's owed us money for over 90 days, it's less likely that they're going to pay us. And so the two different methods either emphasize the income statement or the balance sheet. When it comes time to set our bad debt expense a second time, if we use percentage of sales to estimate it in the first place, we don't care about any balance that's hanging out in allowance for doubtful accounts. But if we used our percentage of receivables method, we do care about that allowance for doubtful accounts, and we take that existing balance into account when it comes time to reset. So in summary, there are two basic methods to account for accounts receivable that go bad. The direct method, we write it off when that particular account receivable turns out bad. And the better way, the one that's required by generally accepted accounting principles, is we write off bad debt expense in the period that our sales are made, maybe every month, maybe every quarter, maybe every year. And that's going to give us a matching of our bad debt expense with our sales. And in that method, we can't credit specific accounts receivable. Instead, we credit that placeholder account called allowance for doubtful accounts, and we simply use that up as specific accounts receivable go bad.